And Pandora may not be trading yet, but that hasn't stopped one analyst from telling his clients not to buy into the offering. Bloomberg West editor-at-large Cory Johnson spoke with BTIG analyst Greenfield about his warning to investors and what inspired him to publish the report.
Well, at BTIG, we're not doing investment banking for companies, in the sectors that we're going to cover, and so we have the ability to publish pre-IPO research since we're not involved in the actual offering, and so we find it very valuable to offer clients of the firm research on companies that are about to be public, so they can help make an informed decision about whether or not they should participate in a given IPO. And we did it last year with Real D, and now, as you said, we're doing it with Pandora for the offering that's coming up tomorrow.
So when you look at the Pandora deal, a lot of attention is paid in pre-IPO or companies about to go public when they have fantastic revenue growth. This certainly has that.
It does, although the revenues are still relatively modest relative to the size of the IPO. But you are looking at a company that's going to go from $100 million of revenue and theoretically could go over the next 3 or 4 years upwards of $1 billion. I think the real issue is how much money are they going to make, even if the revenue growth is tremendous over the next 3 or 4 years.
Yeah, I think that's one of the big issues here is about the changing parts of the business model. We always like to say on Bloomberg West that we're not really focused on stocks, which is mostly true, but it's an interesting way to look at a company. But within the IPO filing, you get so much information on the dynamics of the company, even more than your average 10K or quarterly filing. When you dug into the financials, what did you learn about Pandora?
Well, I think one of the things that's really challenging with this particular company, and if you look at internet IPOs in general, but specifically on this one, is that for every hour that you listen to Pandora, there is a fee that goes with it. So their costs are not fixed. They have a variable cost structure. It's a fixed fee per hour. But for every hour you listen to Pandora, they are paying fees for all of those songs. They are paying to the music labels. And so, the business doesn't scale as you would expect. When you look at their costs, their content costs, it eats up 50% of their revenues. That's dramatically different than, say, satellite radio, where the number is, call it 6 to 8% of revenues. And so that cost structure really limits the profit growth of the company.
However, they can continue to sell advertising for that duration of the time that you're listening to music, yes?
They do, and the advertising has certainly increased. A few years ago, there was really no advertising. They've started to build out that advertising business. But remember, when you were in front of your computer, yes, sometimes you would put the screen in the background for Pandora, but you would still end up looking at the screen, and you'd see not just and hear an audio ad, but you'd actually see an actual display ad. As you shift more into the mobile market, and so if you're jogging around, outside, and you're getting an audio ad, you're probably not looking at the screen as well, so you're not getting that multi-platform impression. And even more so, take it to the next step. What really excites people about this IPO is as they move into the car. The problem with the car is they certainly aren't going to be serving you, visual advertisements while you're driving your car, and so you're looking at ads that are going to be purely audio. Those audio price per thousand impressions, CPMs as they call it in the industry, those CPMs are dramatically lower for audio only than they are for display or multi-platform ads as Pandora has been used to in the past.
Yeah, advertisers seem to know that mobile advertising is worth less than advertising that you see at your desktop.
Well, I want to draw a distinction. It's not just mobile advertising, it's mobile audio advertising. So it's actually, it's while you're jogging or while you're driving your car. If you're not looking at the screen, what is the value of a 15-second or 20-second audio ad for a brand? How much do you want to pay for that, whether it's Living Social or whether it's you've heard Foxwood ads recently, or they've done some ads for Best Buy. What is the actual value of that impression, especially when it's a one-off? They only have a minute or so of advertising per hour, so it's very, very short, quick ads. It's not like terrestrial radio where you have several minutes of ads several times during an hour, and so you almost have to pay attention because there's a bunch of ads next to each other. Here it's just that one quick shot and back to your music.
All right, so bottom line, what are you telling your clients to do with this Pandora IPO? Should they be buying these shares at any price?
Well, look, we're very skeptical of the IPO valuation. It was already raised from, looked at an original range of 7 to 9. They've raised it to 10 to 12. Obviously unclear whatever retail demand may do to something like this, because obviously consumers know of this service. But when we look at our institutional clients, we're advising them not to participate. We think this is going to be a really tough IPO to generate value when you have really no profit over the course of the next couple of years for this company. You're looking at negative EBITDA, negative earnings, really no free cash flow for a few years. And the biggest question mark you have is there's lots of competition. You know, there's articles all over the place over the last few days that Spotify, a big player in Europe, is about to enter the U.S. You've seen new companies like Turntable.fm really just starting off leveraging the Facebook ecosystem. There's a lot of innovation, and you look at a company like Clear Channel that's trying to really reorient iHeartRadio. Lots of competition, big valuation, $2 billion, and they don't make money. That scares us, and we'd advise clients not to buy at this level.